Tokenization isn't an asset class. Tokenization is an improvement to every single asset class.
Is it going to be TradFi? Is it going to be DeFi? No, it's just going to be finance. There's a little bit of an arms race right now in tokenized equities. Ironically, I don't actually think tokenized equities is like where most of the growth is going to be happening.
They consider blockchain and tokenization as a core part of their corporate strategy.
Eventually, we're going to be talking about 10 billion, 100 billion, trillions.
Some of the biggest mistakes we're seeing projects make when bringing RWAs on chain is that
I'm Niklas Kunkel, founded Chronicle, I think 5 years ago now. We've since become one of the largest oracles in DeFi, securing cumulatively over 15 billion, and the largest tokenized asset oracle, which we have been developing closely with Bhaji at Centrifuge.
Hello, I am Bhaji, CEO of Centrifuge. Centrifuge was founded in 2017. So one of the earliest platforms focused on real-world asset tokenization. We're focused on pairing tokenization infrastructure, so the protocol to tokenize assets and represent those assets digitally on-chain, with fund operations, on-chain strategies, and then integrated distribution. So we work closely with asset managers like Janus Henderson, Apollo, New York Life, as they're thinking about building and scaling their tokenization strategies. And then we also work closely with DeFi protocols like Aave, like Sky and Athena, as they're thinking about building real world yields into their platforms. We have almost 2 billion in assets under management. Part of the reason why we chose Nick and Chronicle is what Nick mentioned in the introduction. They were truly the first to recognize that there needs to be a service that integrates off-chain data on-chain. They have the deepest understanding of the role that oracles should play for real-world assets. So for Centrifuge and RWA platforms, we need oracle partners and providers because the assets and the events that determine the value and the risk and the rights of investors often exist off-chain, while the tokens that represent those assets exist on-chain. So the role that Chronicle plays is, how do you make this real-world data available and accessible and verifiable to the on-chain economy? Some of the biggest mistakes we're seeing projects make when bringing RWAs on chain is that in the early days, there was just this idea that you can tokenize an asset and then there will be liquidity for that asset and there will be demand for that asset. And what that meant is that there were a lot of projects that had false starts where they brought their products on chain and they invested time and energy and resources into building tokenization strategies. And they fell flat because there just wasn't that demand and there was no growth for those products. So the big shift that we at Centrifuge have made and we've seen the industry make is a demand first approach, not just building tokenized assets and hoping demand comes, but working very intentionally to build the right products for the industry and the market and the demand that we do have on chain today.
An important observation to make here is going to be around asset classes that were previously kind of difficult to finance, not assets that were already liquid, right? And so while tokenized treasuries were certainly a huge kind of catalyst for tokenized assets kind of scaling and taking off, that's really not where like all the innovation is going to be happening. I think we're also going to be looking into probably like renewables, right? Private funds, infrastructure financing, trade finance. And I think part of that kind of speaks to like this move from periodic finance to continuous finance. When someone sees the JAAA announcement and the 1 billion allocation by Grove into JAAA, what they're not seeing is all of the years of work, right, leading up to this that led to this moment. And as kind of the counterparty risk and trust assumptions kind of subsided, Grove was able to eventually, right, scale this into the 1 billion allocation that you see. This is not, just throwing caution to the wind, right, and like putting up a big headline number, right? This is the culmination of years of experience and trial and error. And frankly, 1 billion when it comes to, the total size of financial markets is still quite small, right? We're just going to be iterating from here. And eventually we're going to be talking about 10 billion, 100 billion, trillions.
I think the trial and error comment that Nick made is really on point. There's this Lindy effect of the platforms that have been focused on this technology for the longest, that have survived dozens of audits and iterations and learnings and evolutions over the years, where it's not just the technology that we have today, it's the years and years and years of institutional knowledge and experience that has gone into that. And I think another interesting point to make in this scenario is that one of the challenges that we've had as an industry for tokenization is that in the past, there's been somewhat of an adverse selection bias, where it's the managers who can't raise capital off chain that are coming on chain, or it's the lowest quality products that are being brought on chain. But for Janus, for instance, JAAA is their flagship product. And the fact that they built and tokenized and created this strategy on chain shows this deep validation that they consider blockchain and tokenization as a core part of their corporate strategy. And on the issuer side, there's this recognition that the time is now to put your brand behind the work that you're doing and to really bring your best products into the ecosystem, because you can see real meaningful growth of those products.
I don't think the future of tokenized assets is you have $1 trillion of assets being tokenized, right? I think it's more like a future of $1 trillion of assets that are now programmable, when every asset can be used as collateral, traded globally, settled instantly, and integrated into DeFi protocols. That's when you get this platformification of finance, right? That's when finance stops being this collection of institutions and just starts becoming this layer that you can interact with.
An interesting point that Nick touched on that I'll double click on there is thinking about the customer experience where blockchain is fully abstracted. So from a user, if you're in an app and you want to swap between gold and stocks and fund and an index and a US dollar, that can just happen where it's seamless and it's instantaneous and it's free. And I think for us as an industry, it'll be an interesting awakening when we're there and everything is tokenized and there's trillions of dollars flowing, but nobody cares that it's blockchain that enabled that, because it is the invisible infrastructure that's just better technology that helps the system run.
I completely agree with that, Bhaji. And I think it kind of raises the question of how superfluous some of the B2C efforts were in the past, of your grandma needs to have a crypto wallet and needs to be using stable coins, right? And I think that was largely unsuccessful, and in hindsight, almost a bit humorous. Because that's not how this is going to work, right? Crypto is going to be invisible in the background, but it will be pervasive across every facet of finance, right? Equally, I think superfluous is this question of is it going to be TradFi? Is it going to be DeFi? Is it going to be some kind of mix? And no, it's just going to be finance. It looks like there's a little bit of an arms race right now in tokenized equities, right? We recently just saw, announcements from Uniswap, announcements from Coinbase, announcements from Binance, right? So that space is really heating up. Ironically, I don't actually think tokenized equities is where most of the growth is going to be happening. I think most of the growth is going to be happening in kind of more exotic financial instruments that aren't as liquid today, that DeFi is going to instantly make liquid.
And I think there's some interesting, very, very simple benefits that we sometimes look past because we're so accustomed to it, but 24/7 trading, nights and weekends, all the time. We're not confined by banking hours. That's powerful. Global access and distribution, and someone in an emerging market being able to access these products and buy fractional shares of them where there isn't limitations of what size they need to be and what accreditation they need to have. So broad access, instant settlement, finality, 24/7 tradability are these core fundamental primitives of blockchain that make the systems fundamentally better. And then to Nick's point around the collateral use case, some of the value props that we're starting to drive forward and see already right now is depositing your S&P 500 and Morpho and borrowing against it. So borrowing against stocks that you hold. And that's possible in traditional markets with your brokerage account, but not for everyone and not easily. So starting to take these products that are available off-chain, bringing them on-chain and making the on-chain version better than the off-chain version.
I think what people are not understanding, right, is the composable nature of tokenized assets is what's going to help them scale. When you see, some headline of like 500 million or a billion of assets were tokenized, and then they just sit inert on chain, or they're just transferred around a little bit, that's not novel and that's not very useful either. It really only matters when we start to integrate tokenized assets into the fabric of DeFi. And these are difficult problems, and they don't really make the headlines when we kind of chip away at them. But I think there are several milestones which kind of get us from 0 to 1. I think Bhaji just brought up like a really critical one in that you need to have, high liquidity redemptions, right? One of the reasons why you have not seen like tokenized assets integrated into Morpho markets scale to the hundreds of millions, right, is because those positions are either A, really difficult to enter, or B, really difficult to exit. So what we're seeing with Grove Basin, right, providing this, $500 million kind of liquidity sleeve to tokenized money market funds like the Janus Henderson JTRSY product, like the BlackRock BUIDL product. That is a huge unlock, not just for DeFi, but for tokenized assets that I don't think is being given enough attention. And so once we've figured out this like magical recipe, scaling is, not a question of if, it's just kind of preordained. The risk is more that we scale too quickly without putting kind of the proper like safeguards and infrastructure and checks and balances in place.
The last thing I'll just add is that we want people to take that tokenization isn't an asset class. Tokenization is an improvement to every single asset class. So the resounding takeaway is that this is the core infrastructure that powers the future of finance. We have some boring stuff to work through and we're doing the plumbing and it's not that sexy and it will become invisible, but it's the core infrastructure that enables this future that we all imagine and that we're all working towards.